Hey guys, David Baker, Keller Williams. Thanks for joining me here today. Today I really wanted to address the housing market and the 2020 forecast. And really, I think one of the best ways to do that is look at 2008 when the market crashed and look at 220 right now. And the reason is I keep on getting people that think the market's going to crash. The market's going to crash. And I got to tell you, I think that there's some very solid reasons as to why that is not going to happen. So let's go ahead and hit them. Please go ahead and leave comments, give it a like, subscribe, hit that little bell. That way you're informed every time I put up a new video. So getting to it, let's look at 2008. What were some of the things that were going on pre-2008 that potentially caused this market turn down that we saw? I'll tell you what, a lot of the loan instruments that were done at that time were really, I think, partly to blame for it. There was little to no money down loans that were out there. There was a lot of adjustable rate mortgages. We call those ARMs. They had, the 3-year, the 5-year, the 7-year, basically interest-only type of payments. They were doing a lot of no-doc loans, basically giving people loans without doing a lot of verification of assets, income, etc. And then on top of it, there was also subprime loans that were being done. And these are to people that don't necessarily have the best type of credit. Add that all up and add to the fact that, Wall Street was investing heavily into it. When one domino collapsed, a lot of them collapsed. So that was one big thing. Also, I think a huge segment of the population got into the big dad, rich dad, poor dad thing and got into investing. And a lot of people were speculating on buying homes, buying it, not with any intent whatsoever to rent it and to hold as an investment property, but more so to hold on to it for a very short period of time, turn around and make a ton of money on it. So there was a lot of people that really got caught with their pants down, so to speak, and were not able to continue making payments. They never planned on it. And of course, because it was 100% financing, the home just foreclosed. They didn't have anything invested in it. So anyway, those are some big reasons right there. Also, let's look at the fact that, back then, the Dow Jones was about 15,400, give or take. Now, let's look at 2020. What is going on right now? Well, the Dow Jones right now is at around 24,000 something. So we're up almost 10,000 points, give or take. Now, I'll tell you what's interesting is the Dow did go down to about 10,000 from the 15,000 that it was at back in 2008. So if we do see that drop over here, it's still, quite a bit above where, that time frame back in 2008 saw. So overall, stock market is going real great. Back in 2008, like I mentioned, all those loans, subprime loans, they're gone. The no-doc loans without verification, they were gone. A lot of people that bought speculating that homes were going to be, just going up and up and up in value, they have not bought. So you're looking at a whole gamut of people that are not in the marketplace right now expecting, these appreciations. So two huge differences right there, and that is big. Now, on top of it too, you had some indicators back in 2008 that I think, things were coming down the pipeline. One of which, you started seeing vacancies go up for rentals, and prices, started going down as people were trying to get tenants in place. Now at this point, boy, I'll tell you what, there is nothing available and rents have gone up. And even though we do have the COVID crisis going on right now, rents are still holding steady, if not slightly appreciating. Home values are slightly appreciating. So things are going very, very strong with the real estate market. We've had appreciation since 2013. I don't think that'll stop, especially not with this low inventory that we have right now in the Phoenix area. So all that said, I don't think we can really expect to see a housing crash. Now, that being said, there is some speculation because of COVID and because of, maybe the layoffs that need to happen because of businesses slowing down, unemployment maybe having a little bit of a factor. And I got to tell you, back in March is when this COVID thing started and when the economy started tanking as well. We have not seen it affect the real estate market at all to this point, at all. the real estate market has just been continuing going at this point. So if that does continue, there is no indicators at this point that it's going to change the real estate market. And one of the key reasons for that, I think, is interest rates. Right now, this week, interest rates, you could buy a home for under 3% if you've got the credit to do it. And even if it was a little bit above 3%, do you guys realize how freaking awesome that is? Interest payments, basically your monthly payment is lower today than it was for somebody that bought a cheaper home a year or 2 years ago. So it is a phenomenal time to get into a home, and those interest rates are really, really helping. So all said, that points to the fact that it's actually potentially cheaper again to buy a house now than it is to pay rent. And then over time, imagine you stay in that home for 30 years. At that point, you turn around and you sell the home. That was your second retirement account right there. It's forced savings. So anyway, that's the update. Those are the two real major ways I look at the 2008, 2020. I do not foresee a housing bubble bust, and that is my forecast. Please leave your comments. Let me know what you think. Subscribe and hit that bell so you're notified every time I put up a new video. Thank you, and I'll see you on the next video.